Hello, my fellow investors, and welcome back to another fundamental analysis video. Today, guys, we are going to once again cover the company United Health Group, mainly because this thing has fallen a lot recently. A lot, especially after the CMS declared that they're going to pay out less to health insurers. Yeah, this thing fell so much to the point that we are at 52-week lows on this juggernaut of a company. And I mean that literally, because their fundamentals are absolutely insane. And on top of that, last time we actually covered this, we actually only covered this on the 5-year scale. I did not have the 10-year calculator available last time I covered this. So now I want to take a look at this in the 10-year and see if the graphs follow that exact same format that we saw on the 5-year scale. Because if they do, well, then that just gives a lot of credence as to the fact that this company is absolutely insane when it comes to their fundamentals. So I want to cover that today. But before we get started, make sure to like, subscribe, comment. It really does help her with the algorithm on YouTube as well as Rumble. Make sure to follow us on X. And if you guys would like to see us live, normally we're live Tuesdays and Thursdays, 7 p.m. Eastern Standard Time. However, for this week, we were live on Wednesday, and tomorrow, or by the time you guys see this today, we're going to be live in just a few hours, 7 p.m. Eastern Standard Time. So, and with that said, let's get started with the fundamental analysis of United Health Group. So let's get started with the company's profile, just in case anybody who doesn't know. The quick TLDR, it is basically that they are in the health insurance industry. However, to be more specific, the company operates through 4 segments: United Healthcare, Optum Health, Optum Insight, and Optum RX. The United Healthcare segment offers consumer-oriented health benefit plans and services for national employers, public sector employees, and mid-sized employers, small businesses, and individuals. Healthcare coverage and health and well-being services to individuals aged 50 or older, addressing their needs. Medicaid plans, children's health insurance, and healthcare programs. So yeah, guys, they're in the medical health insurance, which if you guys have noticed that I have recently been wanting to get into the health insurance industry when it comes to my portfolio, because there's a lot of money, guys. There's a lot of money to be had here. I've said this in the previous videos that I cover this company, and I'm going to keep saying it because it is 100% true. It is 100% true. This is the one industry that people say, oh, you know, the healthcare, it's too expensive, right? Healthcare is just too expensive and insurance is too expensive. Yet at the end of the day, everybody always gets it. In fact, one of the main reasons why people go to work, aside from just, getting paid and having a paycheck, is mainly for the health insurances. So this is something that is not going to go away in the slightest. And, well, this is a company that is the biggest, if I'm not mistaken, it is the biggest in the industry, probably second to that of Aetna. Regardless, though, it is one of the biggest, and it is one that has a lot of potential, especially after you take a look at these fundamentals. However, though, let's take a look at these earnings. Last time we saw these earnings were on January 12th. Oh, wow. So we're getting these earnings this month then. EPS normalized actual came in at $6.16. That was beat by 17. EPS gap actual $5.83, beat by 17. And a revenue of $94.43 billion. That was a beat, guys, by $2.25 billion. The next earnings will be on April 16th, which is, well, by the time you guys see this, it'll be in 4 days. However, the EPS normalized estimate now, it is $6.62. EPS gap estimate of $6.32. And revenue of $99.29 billion. Guys, 17 revisions, 14 to the downside. So, this may actually be a pretty good indicator as to how the company may do, which, if the company does end up falling even more, that's just an even better buy for me. So these were the latest earnings and the upcoming earnings for UNH. So let us jump into another calculator. We got the ticker for UNH, market cap of $407.24 billion, PE of 18.51. Hang on a second, guys. I really want to see what this PE was the last time I covered this company. And here is my past video, and the PE, guys, when I recorded this, it was 23.33. So yeah, the company has fallen a decent amount to the point that now the PE is in the green for me. Coming back over here to the present, we can see that the current share price, it is $441.72, which, if we take a look at this on the 1 year, this is down 15.21%. Year to date, 16.1. Guys, we are at 52-week lows. We are at 52-week lows, and I'm looking at this, and I'm just like, this thing just fell over $100. absolutely insane. So does this mean we buy it, right? Does this mean that this is an absolute buy because of 52-week lows? No, but it is a great starting point. It is. You are starting the day on the right foot, basically, when a company is at 52-week lows. Absolutely love it. And to show you guys how much things have fallen when it comes to this company recently, this isn't like year over year kind of thing. It's very, very recent. Guys, on the 1 month, down 7.63%. Most of this came right here as of April 1st, going from 489 to what it's at today. However, this was mainly due to the fact that the whole thing with the CMS not giving a boost when it comes to the payment plans for insurance companies. That's the reason why this thing took a tumble, and it's been falling ever since. Now, today alone, as if I'm recording this, it is April 11th. You guys can see that this thing fell again, 1.85% or $8.33, and post-market 0.13, 57 cents. Coming back over here to the calculator, they do pay out a dividend of $7.52, which is a yield of 1.67. So the yield is still a little bit low. However, if this thing continues to fall, that yield should increase. A payout ratio of 29.02, 5-year CAGR of 15.87. So I look at this 5-year CAGR and this 1.7% dividend yield. Honestly, this kind of double digit when it comes to the 5-year CAGR is great, because it just shows that you're getting a nice possible paycheck in the future, or a nice possible raise in the future. 14 years of consecutive dividend payment. Ex-dividend date, guys, however, unfortunately passed as of March 8th. Payout date was on March 19th, and they pay their dividends quarterly. Coming back over here, we can see that based off of the current shares outstanding, they pay out almost $7 billion in dividends every single year. Take the 10-year average free cash flow, subtract this number, and you have $8.4 billion. Take the last year's free cash flow, and this thing just skyrockets. $18.7 billion, guys. Absolute insanity. These payout ratios are really, really good. The last year's free cash flow payout ratio, it is 27.06%. I mean, I like under 60. This is just perfection. And the 10-year average, 45.25, also really, really solid. So what this tells me is that not only can they afford the $7.52, but they can continue to increase it if they so wish to do so. Now here's where the fun starts. The fundamentals, starting with the net income. Wow. You guys are looking at this graph, right? Here's the thing. Pretty much all the graphs look like this. Yeah, I'm not even joking. Almost all the graphs look like this. It is so incredible to see this. And guys, this is on the 10-year. The last time we covered this, it was in the 5-year, and it looked just as fake as this. I swear, I didn't just type in the numbers and made it look like this. This is their actual numbers from their balance sheet income statement. So this is absolutely crazy. Net income 5 years ago of $5.62 billion to 1 year ago of $22.4 billion. Massive increase of almost 300%. But the thing that I like the most is the consistency. That trend line hits those graphs almost every single time. Guys, this is an easy 100%. Moving on now to the free cash flow. It looks almost exactly the same. We got 10 years ago of $6.5 billion to 1 year ago of $25.7 billion. They did have a little bit of a hiccup 4 to 3 years ago where they went down by like $1 billion. So probably COVID related. They had to do a lot more, I guess, paying out insurance due to COVID, right? But you can see that was a nice rebound. Overall, though, this is an increase of 294% with an average of $15.4 billion. Isn't easy again, guys, 100%. And the revenue looks by far the fakest so far. Out of all the 3 profit metrics, I mean, this thing just, I'm speechless. I'm really speechless. 10 years ago of $130.5 billion to 1 year ago of a whopping $371.6 billion. Dear Lord, increase of 185%. I mean, 100%, guys. This is the profit metrics. All 3 profit metrics are at 100%. I think to be fair, we could just stop right here, right? We could absolutely just stop right here because we already know where this is heading. However, let's continue for video's sake. Here are the assets as a reference only, as well as the liabilities as a reference only. Doing the assets minus the liabilities, we can see here that this is a nice in steady increase. Now the 1 year and the trailing are the same because I needed to make the numbers work, so I made them the same. Average total assets of 180.75 billion, liabilities of 116 billion, a difference of 64.65 billion dollars. I mean, guys, as an easy also 100% as well. Now remember when I said that almost all the graphs look like the net income? This isn't the one. This is the only one, guys, that's actually looking horrendous. It's really, really bad. This is consistently decreasing, or pretty much almost consistently decreasing, to the point that as of 1 year ago, they're at negative $149 billion. This is the cash flow minus the liabilities. They're packing on liabilities, even though their cash flow is going through the roof. So they're packing on liabilities. However, it may just be an industry thing. They had one instance where it kind of remained flat, but all in all, guys, it's just down, like horrendously down. Average cash flow minus average total liabilities of negative $98.5 billion. Sorry, this is the only zero that this company is going to get right now, and it's in the cash flow minus the liabilities. Now, the shares outstanding, even though they do look very, very good, it's not 100%. However, you know, it's still looking very, very solid. Shares outstanding 10 years ago of 954 million shares to today of 924 million shares. That is a buyback, guys, of 3.14%. And from the previous year to the current year, another buyback of 1.07%. They increased a little bit from 8 to 7 years ago, going from 952 to 969. But you guys can see that it was very, very strategic, right? It's not like they continued. In fact, they issued and then they just bought back afterwards, going from 969 to 960 to 948, 946, 941, 934, and then 924. So all in all, I'm gonna have to give this a solid. I don't want to give it like an 80. Let's give it like a 95%. Essentially, it's a really, really solid buyback. And lastly, looking at the cash equivalents, they currently hold $25.43 billion with an average of almost $16 billion. So my overall grade, to my surprise, is actually not over 90. Mainly because of the cash flow minus the liabilities, guys. Wow. Honestly, if I were to put the shares outstanding of 100, this probably would swing it to 90. But I mean, you have the three profit metrics at 100, the assets minus liabilities is 100, shares outstanding of 95. Guys, this is a beast of a company, right? The cash flow minus the liabilities is looking horrible, but it may just be an industry thing, honestly. I would need to do more research on that. Regardless, though, 89%, the profit metrics look chef's kiss perfect. So yeah, I really do like these fundamentals, as you guys can clearly see. So now let's take a look at the calculator, and right off the bat, these numbers are looking insane. 1,300 not adjusting for debt and 1,283 adjusting for debt. Now let's input some of these numbers. In the past 10 years, guys, this revenue has increased every single year around 18.5%. And you guys just saw the graph. It's absolutely incredible. It's near perfect. So I'm almost obligated to put the median revenue, a growth assumption of around 18% for the next upcoming years. Not 28, but 18%. My bad on that one. For the low assumption, let's go down by around 4%, and let's go down to 14. And then for the highest assumption, let's go up by 4% again, and then let's put 22%. We're gonna go all out. Wow, wow, $13,950. Absolutely crazy. We're not done yet, though. Now, for the projected share buyback, they have been doing around 3%. So I suggest we just do the 1, 2, and 3% for the projected share buyback. And now for the required rate of return. This is the one that's going to bring these numbers down a lot, because the more return you want, the lower price you would have to pay for it, right? So let's input, guys. I mean, this company has been doing insane, right? Absolutely doing insane. In fact, just looking at the 10-year graph that we have right here, this thing is up a whopping 503%. Now, I'm not going to put 503, obviously. It'll just become a penny stock after that. However, I would like to get a nice chunky return when it comes to UNH. So I'm going to say, guys, roughly at around 15% in the next 10 years, which is a decent amount, right? Which is actually, I would call it on the low end of that. We could change it to around 20 or a little bit higher afterwards. But with 15%, guys, for the lowest assumption, you would need to buy this company at $741.56, all the way up to $1,324, not adjusting for debt. And then adjusting for debt, $723 to $1,305. Margin of safety of 5, 10, and 15 of $615 to $1,240. Now, does this mean that, oh my goodness, this is a buy right now. Again, guys, this is all based off of the assumptions, right? So I'm basically saying that in order for me to get a 15% return in the next 10 years, I would need to buy this company at 741. So by this logic, then at 441, this is looking it's absolutely looking like a bargain. However, if we were to just change the required rate of return, let's say that you want a 20% required rate of return in the next 10 years, which is more akin to, what we may actually get, seeing that this company is a juggernaut. These numbers now change to 480 to 805, not adjusting for debt. And after debt, $462.63 to $787.17. And then with a margin of safety of 5, 10, and 15, 393 to 747 or 748 technically. Meaning that at 441, guys, you are basically, I wouldn't say guaranteed, but you're basically wanting to get a 20% return right now, assuming that they make a 14% revenue gain in the next 10 years and buy back shares at 1%. On average, which is really, really good. 20% in 10 years is absolutely incredible. That's also not taking into account the dividends as well. And if we do take a look at these dividends, we can see that putting in $6,215, this nets you an annual, whoa, okay, really? Yeah, I just had to check on that one, guys, really quickly. Yeah, this would net you $105.81 in annual dividends, quarterly of $26.45, and a monthly of $8.82. So, it's it's looking a little bit interesting, especially now the fact that this is at 52-week lows. All in all, guys, United Health Group is a company that, you guys, I've done 3 videos already on this just this year alone. So you guys know that I really do like this company. And you know what, something? Even though I said I wasn't going to buy any companies right now because I have other obligations, I'm very tempted to at least buy an extra share at this current level. In fact, I just bought my wife a few partial shares of this company yesterday, if I'm not mistaken. Wednesday, which the company also fell a decent amount. So I do like this company. I know Bassamatic usually on the live stream says he wouldn't touch this until 441, if I'm not mistaken. Well, it just hit 441. So I'm very, very curious, guys, what you think about this company, and are you willing to buy it? Because honestly, you may not like health insurance, guys. You may not like the healthcare sector. You can't deny these numbers, guys. You just cannot deny these numbers. So tell me what you guys think. And of course, make sure to like, subscribe, comment. It really does help her with the algorithm on YouTube as well as Rumble. Make sure to follow us on X. And if you would like to check us out live, guys, we normally are live on Tuesdays and Thursdays. However, for this week, we were live on Wednesday, and tomorrow we will be live on Friday, where we're going to cover the bank earnings, because Q1 earnings begin tomorrow, or at least for the banks, right? At least for the banks. So that's going to be really, really fun. We're excited to read what JP Morgan has to say about the economy, or more specifically, Jamie Dimon. So with that said, guys, peace out, and we will see you all next time.